So the next topic might be, how do we control cash disbursements? Now, one way, a very important way, is to make sure that all of our expenditures are made by check. We deposit all of our cash into the bank, so now we're going to try to spend all the money by check. That way we have an immediate receipt, and we know that check had to be authorized through our procedures. We do make an exception that we'll talk about for petty cash payments. What we're basically saying there is, we know we're going to have this big voucher system, this big approval system. That's fine for bigger purchases. But if we just need $10 for stamps, do we really want to go through this huge process to protect $10? So that's why we have petty cash. We'll see that in just a bit. We've already mentioned separating the authorization for check signing and record keeping duties, and then we'll focus in on that voucher system that we've been talking about. So the voucher system of control, we're talking about how all of these cash disbursements are approved. What process do we go through? And here's the illustration that shows this. It looks convoluted, looks cumbersome, but it serves a purpose. So we start off with the requesting party. They want something, so they submit a purchase requisition to the purchasing area. And a copy of that goes to the accounting area as well. So we're basically saying, please purchase this for us. The purchasing area, if they approve it, then they'll submit a purchase order, which goes out to the supplier, obviously, so they can start working on it and shipping it to us. A copy goes to the requesting party so they know that it was approved, it's ready, just about ready to go. The receiving area gets a copy because they should be expecting this inventory or whatever in the near future. And then again, the accounting area gets a copy as well. The supplier or vendor would get the invoice, or no, they wouldn't get it. They'd send the invoice to accounting. They would also send the product to the company, and the receiving area would get that. The receiving area, after counting everything, they'd complete a receiving report to show what arrived. They'd send this receiving report to the accounting area, to the requesting party, and the purchasing party, so that they know that everything's done. The requesting party now knows to come pick up their items. The accounting area, after getting a copy of everything below, they know that something was approved, something was ordered, something was billed, and something was indeed received. So they'll approve the invoice. Then they'll send that to the cashier, who then sends a check out to the supplier. So that's the separation of duties. That's how a voucher system works. Again, it's great for larger and repetitive purchases, but it doesn't make much sense for a small purchase like a book of stamps. That takes us to petty cash. We're talking about small payments for items like postage, repairs, supplies, just small things where we're not as concerned with applying that huge voucher system of control to protect it. So what we have here, we have a separate petty cashier, first of all, that will hold the cash. The company cashier has access to the checking account. They don't have access to cash itself. They don't keep all of their money in a big safe. So they write a check for whatever that small amount is to the petty cashier. The petty cashier then goes to the bank and turns it into actual cash, dollar bills and coins. The accountant will make a record, make a journal entry to debit petty cash to increase it, and credit cash to decrease that asset. Both of these are assets. We're just moving cash from one account to the other. Obviously, the petty cashier needs that true cash, and they will put it in some sort of safe, hopefully not just shoved into their desk drawer where anybody could see it. They still need to control it, just not in a bank. The key thing here is that money is not up for grabs. Nobody can just go grab whatever money they want. They have to use it for a business purpose. So if they need to buy stamps or they need to pay courier fees, they can do that. Now what happens here is when they do make those purchases, they should give the petty cashier those receipts to prove that, hey, here's the reason this money is gone. After a while, when the fund starts to get low, the petty cashier will take all of those receipts, they'll give them to the company cashier and basically say, here's $125 in receipts. I need $125 in cash back to replenish the fund. The accountant will record those expenses and they'll credit cash to reduce the cash again. Notice they didn't debit petty cash this time. They're only crediting cash. They're debiting these expense accounts. Hopefully your receipts match up with exactly how much cash needed to be paid back to the petty cashier to replenish the fund to that preset level. In some cases, maybe you're $1 or $2 off. Maybe you're missing a small receipt. You may reflect that in a cash over and short account. It's like a miscellaneous expense or miscellaneous revenue account. The one thing to note here is that the petty cash fund, the only time that's ever debited or credited is when the company is first started and when the company decides to change the level of petty cash. Not replenish it, but change the actual level. So here's a petty cash example. Tension Company maintains a petty cash fund of $400. The following summary information was taken from petty cash vouchers for July. So all these expenses we had. The balance on July 31st is only $137.80, where we want it back to $400. So we need to replenish the fund. Here are all the expenses we have. The first question is, what amount of cash do we need to replenish the petty cash fund? It needed to be at $400. It was only at $137.80. So we subtract the two, $400 minus $137.80. That tells us we need $262.20 to replenish this fund. What is the journal entry going to be? We're going to debit all of our expense accounts, and then we're going to credit cash for that $262.20 that we had to use to replenish it. Now notice, if you add up all of your expenses, you only come up with $260.20. You're $2 short on the debit side, so we're going to have to debit cash over and short for that difference. Now we start to focus in on bank reconciliation, the banking activities themselves as controls. I said that the bank is an important control. Here are some of the reasons why. First of all, the fact that we have a bank account gives us a record of what had happened, what increases did we have, what decreases did we have. Signature cards, that helps with the authorization process. If someone signs a check and that isn't the proper signature, the bank, especially if it's some material amount, they'll want to compare this signature to what card they have on hand that was signed when the account was opened up. If the signatures don't match, they shouldn't cash the account. They should ask further questions. Deposit tickets, that's a good control because it helps to ensure that when we make a deposit, it's going into our account. When we say deposit tickets, we're talking about pre-printed deposit tickets that have your account number at the bottom. That ensures that when we deposit money into our account, there's no typo. Nobody's accidentally keying in the wrong number because maybe they couldn't read our handwriting. With checks, it's much the same. It's pre-printed. You want to make sure that when you spend money, it's coming out of your account. Or certainly someone else wants to make sure that when you spend money, it's not coming out of their account. EFT, electronic funds transfer, this is a control because it takes the whole issue of having cash on hand out of the picture. If you have EFT, this means that you can make a payment electronically without ever having to write a check, without having to send cash to anybody. And on the other hand, you can receive cash from your customers electronically without anybody in your company having to touch the cash. And a bank statement, that leads us to the reconciliation side. This is a record of what happened. We can compare it to our internal records to see if everything matches up. And that takes us to the bank reconciliation itself. Probably the most important control out of the entire banking activity. We take a look at the bank statement on a monthly basis. They send it to us. We compare it to what we have in our records. The balances generally won't match up, and it's not a problem. It's due to timing. Due to the timing of when we reported something versus when the bank reported it. So we have to look at what could cause those timing differences or what could cause those issues that we need to reconcile for. On our reconciliation, we're going to have two different sides. We're going to have a bank statement side, reconcile for all the issues that are maybe wrong with the bank statement, if you want to think of it that way, and then all the adjustments needed to our books on our side, the ledger side, general ledger. For the bank statement side, we're going to add any deposits that are in transit. These are deposits we made. We put them on our books. Our books are correct, but the bank didn't receive them in time to put them on that period's bank statement. So we need to add those into the bank statement side just for reconciliation purposes. We would deduct any outstanding checks. These are checks that didn't quite make it into the bank on time. We recorded them when we spent the money, but maybe the person hasn't cashed the check yet, so it's not taken out of our account. You may have bank errors which you would add or deduct depending on what the issue was. That could happen, and you want to notify the bank about it. On the book balance, we have a few adjustments to make. We may need to add in collections made by the bank on our behalf. This could be where a customer sent money directly to the bank. We may have set up a lockbox agreement, which means that we send out an invoice, and the invoice has a special address printed on it, maybe a P.O. box that goes directly to the bank, and then the bank handles our collections for us. They'll take out a fee, but they'll handle that for us. They'll notify us. We didn't know about this collection yet, so it wasn't recorded on our books, but the bank told us about it, so now we're going to add it in. It's already on the bank statement. Now we have to add it into our side. We may also add interest earned on checking account. The bank already recorded that, but we have not yet, so we need to add it in. We may need to deduct non-sufficient funds checks, bounced checks. Customers have bounced a check on us. We recorded it as cash because we thought it was good, but now we're finding out, no, it's not good. The bank is not recording it. It's not a valid cash item. It bounced. They didn't have enough funds. We may need to deduct a bank service charge. If the bank has already recorded on the statement, we didn't know about it until now. Now we're going to subtract it out. And then, of course, we may have book errors as well. We could add or deduct those depending on what the situation was.